Listen up, because what I'm about to share with you could be the difference between financial freedom and financial disaster. This is probably the most important money question you'll ever face, and I guarantee most people are getting it completely wrong. Should you invest your money or pay off your debt first? The answer might shock you, and it's definitely going to challenge everything you think you know about building wealth. But before we dive in, I need you to do something crucial right now. Hit that subscribe button and join this community of people who are serious about transforming their financial lives. We're not here to sugarcoat the truth or sell you get-rich-quick dreams. We're here to give you the real strategies that actually work. Here's the brutal reality that nobody wants to talk about. Right now, millions of people are making a catastrophic financial mistake every single day. They're carrying credit card balances while simultaneously trying to build investment portfolios. They're paying 18% interest on consumer debt while chasing 8% returns in the stock market, and they think they're being smart about money. Let me paint you a picture that will change how you think about this forever. Imagine you have $10,000 sitting on a credit card charging you 18% annual interest. That means you're hemorrhaging $1,800 every year just for the privilege of having borrowed that money. You're not buying anything new, you're not getting any service, you're just paying a penalty for past financial decisions. Now let's say you decide to invest that same $10,000 instead of paying off the debt. If you're incredibly lucky and pick all the right investments, maybe you'll earn 10% returns. That's $1,000 in gains. Sounds pretty good, right? But here's the problem. While you're making $1,000 on your investments, you're losing $1,800 on your debt. Your net position is negative $800. You're actually getting poorer while thinking you're building wealth. This is what I call the wealth illusion, and it's destroying people's financial futures. You cannot build real wealth while carrying high-interest consumer debt. It's mathematically impossible. Yet every day I see people trying to do exactly this. They're watching investment videos, researching stocks, buying cryptocurrency, all while carrying credit card balances that are eating them alive. The first thing you need to understand is that not all debt is created equal. There are fundamentally two types of debt in this world, and treating them the same way is a massive mistake that will cost you dearly. The first type is consumer debt. This includes credit cards, personal loans, car payments for vehicles you didn't need, and any other borrowing you did to purchase things that lose value over time. This debt is toxic. It's financial poison, and it has absolutely no place in your life if you're serious about building wealth. The second type is investment debt. This includes mortgages on properties that generate rental income, business loans that help you create more revenue, or even student loans for education that genuinely increases your earning power. The key difference is simple. Investment debt should put money in your pocket over time, while consumer debt takes money out of your pocket forever. When someone asks me whether they should invest or pay off debt, my first question is always about what kind of debt we're talking about. If you're sitting there with credit card debt, personal loans, or any other high-interest consumer debt, here's my answer, and I want you to listen very carefully. Do not invest a single penny until that debt is completely eliminated. Not $1. I don't care what hot stock tip your friend gave you. I don't care what cryptocurrency everyone's talking about. I don't care if someone promises you guaranteed returns. Until that consumer debt is gone, you are not ready to be an investor. Here's why this is so critical. Paying off an 18% credit card is mathematically identical to earning an 18% guaranteed return on your money. Show me any investment that can guarantee you 18% returns year after year with zero risk. You can't. Because it doesn't exist. The stock market averages about 10% over long periods, but that's not guaranteed. Some years you lose money. With debt payoff, the return is guaranteed and immediate. Most people completely mess up their debt elimination strategy because they try to make it comfortable. They make minimum payments, spread everything out over years, and continue living the same lifestyle that got them into debt in the first place. If you want different results, you need different actions. You need to get uncomfortable in the short term so you can be comfortable for the rest of your life. Let me give you a strategy that actually works. It's called the debt avalanche method, and it's the fastest way to eliminate high-interest debt. List all your debts from highest interest rate to lowest. Make minimum payments on everything except the highest interest debt and attack that one with every extra dollar you can find. Every bonus, every tax refund, every bit of extra income goes toward killing that highest interest debt first. Once it's gone, move to the next highest rate and repeat the process. This is going to require real sacrifice. You might need to cut up those credit cards, stop eating out every night, cancel subscriptions you don't really need, and drive that older car for a few more years. But here's what most people don't understand. These aren't permanent sacrifices. You're trading temporary discomfort for permanent financial freedom. Now, let's talk about mortgages because this is where the conversation gets more nuanced. A mortgage is fundamentally different from credit card debt for several important reasons. First, the interest rate is typically much lower, usually somewhere between 3 and 7%. Second, mortgage interest is often tax deductible, which effectively reduces your cost even further. Third, your home is an asset that typically appreciates over time, unlike consumer purchases that immediately lose value. So, should you pay off your mortgage before investing? Here's my rule of thumb. If your mortgage interest rate is above 6%, I want you to focus on paying it down aggressively before making significant investments. If it's below 4%, it probably makes more sense to make your regular payments and invest extra money instead. If it's somewhere in between, you need to run the numbers based on your specific situation. But here's something crucial that goes beyond just mathematics. There's a psychological component to debt that many people underestimate. Debt creates stress, regardless of the interest rate. It affects your sleep, your relationships, your decision-making ability, and your overall quality of life. I've worked with countless people who were technically making the right mathematical decision by investing instead of paying off low-interest debt, but they couldn't enjoy their lives because of the constant worry about what they owed. For some people, the peace of mind that comes from being completely debt-free is worth more than the potential extra returns from investing. And you know what? That's perfectly okay. Money is supposed to make your life better, not worse. If eliminating all debt allows you to sleep better and feel more secure, then that might be the right choice for you, even if the spreadsheet says otherwise. Here's what happens once you actually eliminate that consumer debt, and this is where it gets really exciting. Suddenly, all that money that was going to credit card companies and loan payments is now yours to deploy toward building wealth. You transition from being a debtor to being an investor, and it's one of the most liberating feelings you'll ever experience. But here's where many people make another critical mistake. They finally get out of debt and then immediately celebrate by going right back into it. They buy a new car, take an expensive vacation, or upgrade their lifestyle. Don't be that person. When you eliminate debt, you need to stay debt-free and maintain the discipline that got you there. Instead, take that same amount you were paying toward debt and immediately redirect it into investments. If you were paying $1,000 per month toward debt elimination, now invest $1,000 per month. Your lifestyle doesn't change, but your net worth starts growing exponentially. This is the real secret to building wealth. Once you start investing consistently and see your portfolio growing month after month, you'll never want to go back into consumer debt again. You'll realize that debt was literally stealing your future, and now you're finally taking control of your financial destiny. Let me also address something that many financial experts won't tell you. Even if you decide the math supports investing while carrying low-interest debt, you better be investing wisely. This doesn't mean gambling on individual stocks, chasing the latest investment fads, or trying to time the market. If you're going to carry debt while investing, your investment strategy needs to be conservative, diversified, and focused on long-term growth. I'm talking about broad market index funds, dividend-paying stocks from established companies, and real estate that generates consistent cash flow. It might seem boring compared to the latest hot stock or cryptocurrency, but boring investments are what build real wealth over time. Exciting investments are usually what make you broke. The bottom line is this, and I want to make sure this is crystal clear. If you have high-interest consumer debt, anything above 8 to 10%, stop everything else and pay it off first. This is not negotiable. You cannot build wealth while being charged 18% interest on credit cards. It's mathematically impossible. If you have very low interest debt, like a mortgage below 4%, you can consider investing while making regular payments, but only if you're investing in solid, diversified holdings for the long term. And if you have medium interest debt, or if the stress of carrying any debt is affecting your quality of life, then pay it off regardless of what the calculator says. Remember, personal finance is exactly that. Personal. It's not just about numbers on a spreadsheet. It's about building a financial life that lets you sleep well at night and pursue your goals without constant worry about money. Here's an important point that many people overlook. The discipline you develop while eliminating debt becomes the foundation for building wealth. Learning to live below your means, prioritize long-term goals over short-term gratification, and make difficult financial decisions. These skills don't disappear once your debt is gone. They become the habits that help you build and maintain wealth for the rest of your life. I also want to address the fear of missing out that many people feel when they're focused on debt elimination instead of investing. They see friends making money in the stock market or hear about the latest investment opportunity, and they worry they're falling behind. This is the wrong way to think about it. Every month you carry high-interest debt, you're guaranteed to lose money. There's no investment opportunity worth pursuing while you're bleeding cash through consumer debt payments. The real opportunity cost isn't missing potential investment gains while paying off debt. The real opportunity cost is the decades of wealth building you'll miss if you don't eliminate that debt and develop proper financial habits now. Every year you delay getting serious about debt elimination is another year of compound interest working against you instead of for you. Let me give you a specific example to illustrate this point. Suppose you have $15,000 in credit card debt at 18% interest, and you're making minimum payments of about $300 per month. At that rate, it will take you over 7 years to pay off the debt, and you'll end up paying more than $25,000 total. That extra $10,000 you paid in interest could have been invested and grown to hundreds of thousands of dollars over a 30-year period. But if you get serious and attack that debt by paying $1,000 per month instead, you'll have it eliminated in just over 18 months, and you'll pay only about $2,000 in total interest. Then you can take that $1,000 per month and invest it for the remaining time period. The difference in your final net worth will be staggering. This is why I'm so passionate about helping people understand this concept. The decisions you make about debt and investing in your 20s and 30s will determine your financial reality in your 50s and 60s. You can't afford to get this wrong. Here's something else to consider. The current economic environment makes this decision even more critical. With inflation affecting everything from housing to groceries, having high-interest debt is like having a financial anchor dragging you down while you're trying to swim against the current. Every dollar you pay in credit card interest is a dollar that can't be used to build wealth or protect yourself against rising costs. Now, I want to address those of you who might be thinking that you can handle both debt payments and investing at the same time. Maybe you feel like you're disciplined enough to manage both simultaneously. While I admire the ambition, this approach usually fails for psychological reasons. When you're splitting your financial focus between debt elimination and wealth building, you're not fully committed to either goal. It's much more effective to concentrate all your extra resources on eliminating debt first, then redirect that same energy and money toward investing. There's also the issue of emergency funds to consider. Some financial advisors recommend building an emergency fund before paying off debt, but I disagree in most cases. If you have high-interest consumer debt, that debt is your emergency. Every month you delay paying it off, you're making your financial situation worse. Focus on eliminating the debt first, then build your emergency fund. The exception to this rule is if you have absolutely no emergency cushion and you're living paycheck to paycheck. In that case, you might want to save a small emergency fund of $500 to $1,000 first, just to avoid going deeper into debt when unexpected expenses arise. But this should be a minimal amount, and then you should focus entirely on debt elimination. Let me also talk about the role of income in this equation. If you're struggling to make even minimum debt payments, you have an income problem in addition to a debt problem. In this case, you need to focus on both increasing your income and eliminating debt simultaneously. This might mean taking on additional work, developing new skills that command higher pay, or starting a side business. The faster you can increase your income, the faster you can eliminate debt and start building wealth. For those of you with good incomes who simply made poor spending decisions in the past, the solution is clearer. You have the earning power to eliminate debt relatively quickly if you're willing to make temporary lifestyle sacrifices. The key is maintaining your current income while dramatically reducing your expenses until the debt is gone. Here's what I want you to do right now if you're serious about changing your financial life. First, make a complete list of all your debts, including the balance, interest rate, and minimum payment for each one. This might be uncomfortable, but you need to face the reality of your situation. Second, calculate exactly how much money you can throw at debt elimination each month if you really commit to it. Third, use the debt avalanche method I described earlier to create your payoff plan. Most importantly, make this commitment public somehow. Tell your family and friends about your debt elimination goals. Join online communities of people working towards similar objectives. The accountability and support will help you stay on track when the process gets difficult, and it will get difficult. Remember, eliminating consumer debt isn't just about the money. It's about reclaiming control over your financial life and your future. Every payment you make toward high-interest debt is a step toward freedom. Every month you delay is a month of continued financial bondage. The choice is yours, but the math is clear. If you want to build real, lasting wealth, You need to eliminate consumer debt first. There's no shortcut, no hack, and no exception to this rule. But once you do it, once you experience the freedom and peace of mind that comes from being debt-free, you'll wonder why you waited so long to get started. Your financial future is waiting for you on the other side of debt elimination. The question is, are you ready to do what it takes to get there? The answer to that question will determine whether you spend your life building wealth or simply making other people wealthy through interest payments. Choose wisely, because this decision will impact every aspect of your financial life for decades to come.